Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday Night Podcast. We are live. Melissa and I are actually sitting here together. We've had crazy winds today. We've had power outages. It's been, it feels kind of, Orlando, I don't know, maybe it's sunny and 85 where you are.
No, it's 45 degrees here in the Midwest.
All right. Guys, we have Orlando Minor with us tonight. Orlando's in the house. He's a fellow YouTuber, and he's actually in the real estate on the commercial side of things. And he is in lending, and what a great guest to have for tonight. Tonight we are going to talk about, another government bailout. So we have, as we know, Silicon Valley Bank, SVB, they had their doors closed last Friday, and there has been two more, Signature Bank and, Silvergate. Silvergate was focused more on crypto. But we have so much going on right now. Guys, if you're not nervous now, we've been talking about the housing market and, the way things have just been crazy with that. Low inventory, high prices. We are seeing price declines, but mortgage rates that are, way up compared to where they were a year ago. And now we have to worry about our money. Now we need to worry about whether we should go. We're going to talk about bank runs tonight. We're going to talk. So many people that I know have stood in line to take money out of the bank, kind of wary, scared that what happened last week and over the weekend was going to have a rippling effect. The stock market was responding to that a little bit yesterday. We did see a rebound today, but we are in some really uncharted waters. And, and we're going to talk about that kind of tonight, our opinion on some things, what we're seeing in the housing market and on the commercial market. So, guys, please welcome Orlando Minor. Orlando, thanks so much, man, for joining us. Tell everybody who doesn't know. Very few people know who you are, right? Especially our audience. Tell everybody who you are.
My name is Orlando Minor. I have a YouTube channel. We talk about the housing market, financial news, just pretty much anything financial. We keeping people up to date on exactly what's happening in the housing market and if you should buy, rent, up to date stuff like we're talking about today. There's these huge bank runs and stuff that's been going on with these bank closures.
Melissa.
Hi, Orlando. So happy to have you back again. Always so awesome to have you as our guest. And yeah, it's been a very eventful past few days. I was at an event today, an expo, and it's what everyone's talking about, especially on the lending side. And rates were talked about as well. Especially where we are in our market, it's still very competitive. So there's a lot going on right now. It's an overdrive, and we are in the middle of March. So looking forward to another great show. You guys keep your comments and questions coming. I will do my best to filter them through and get them answered tonight.
Orlando, did you take all your money out of the bank?
No, I did not. I did not do that. I know that's a really big, I know I've seen, Scott, we saw that. He did a video on 8 people on the ATMs taking their money out. And I even posted a short showing individuals taking their money out of out of banks and whatnot, and the lines wrapping around. So, I've seen it, but I've kept my money in.
Guys, if you take more than $10,000 out of the bank, they have to record it to the IRS. Orlando and I were just talking about this before the show started. I know some people that actually have been really nervous about their money, and they went and got their cash. I think, look, I don't think we're going to see bank runs. We may see bank runs, but I don't see where, especially during these, with the bigger banks, the ones that we know are too big to fail, Wells Fargo, Bank of America, Chase. These are banks that are they're massive. But it is interesting, Orlando. What do you think? What is your opinion on the federal government stepping in and saying that everybody's deposits are safe?
See, I understand the reason why they did it, and it makes logical sense. My issue that I have with it is I don't believe they're going to have that same energy if it was another bank. If multiple banks, would they go ahead and do basically unlimited FDIC protection? And I don't think that they would. I believe that in this particular situation, they're hoping that this would fix and clot and heal the situation so that it wouldn't start, the corruption of all the regional banks. But I believe if there's 2, 3, 4, 5, 6 more banks, I think they're going to limit it to 250. And then the question becomes, is that really fair? Why did SVB get the treatment of unlimited protection, but then all the other banks that, quote unquote, regular people put their funds in is not protected?
I think one of the most interesting things about, SV Bank is that, what was it? Over 97% of the depositors had more than $250,000 in the bank. I mean, I know a vendor specifically. I received an email, and they had said, hey, look, if you're doing any ACH into our account, SVB, please cancel that immediately. That any funds that are received, and this was Saturday, any funds that are received will not be applied to your account. And so I know somebody specifically that was affected by this. And, I don't think a lot of people realize, and it is a fine line. When does the Fed step in and rescue? We've seen it before. They do pick and choose. It does seem that way, right?
Mm-hmm.
It definitely seems like in the past, what we've learned from the 2008 crisis, there were winners and there were losers. Right. And, you had Ford Motor Credit that, or Ford, Motor that was doing amazing. They were bailed out essentially, and GM that was wiped out, right? So, there's an example right there of two companies. And, but when we're looking at the ramifications that happen when people don't have access to their money, payrolls that can't be met, bills that can't be paid.
Mm-hmm.
This is serious stuff, right? But I think the interesting thing is, when does a business, and a bank is certainly a business, when is a business held responsible for their actions? I run a business. Orlando,
Mm-hmm.
you run a business.
Correct.
You can't go out and, look, they had no risk manager for quite some time, right? But everybody should be a risk manager that's lending money. They're lending money to companies. Everything fell apart. I know how it can happen, but, they're not going to bail me out if I go down the tubes and can't afford to pay my employees or my bills.
Mm-hmm.
So I guess, who knows? So what do you think? You think this is going to have any more fallout, or do you think? And guys, and we'd love to hear from you too. We don't know. Are you nervous about your money? Are you nervous about were you somebody that stood in line and took money out of your bank account? Let us know in the comments. We'd love to hear from you.
Right.
I am going to throw this, Orlando. I didn't mean to interrupt you there, but I am going to throw this up there really quick. We've got Oso who just said, I moved money out of bank yesterday. So there you go. Thank you for your comment.
Yeah. So Orlando, are we going to see this spill out? Is this going to continue here?
We spoke about this earlier about the big four. The big four, they're going to be safe, and they have enough capital, and not only that, but they're too big to fail anyway. So that's not something I'm concerned with. What I would be concerned with would be the smaller regional banks. You don't know what's really underneath the hood in some of these smaller community banks. So I would be concerned with that, but it seems the Fed is trying to protect that anyway, because they also brought out a tool that allows any bank, any credit union to go ahead and pull out loans that's basically cheap money, so that if that was to happen, if there was a run on their community bank or a bank in your local area, that they could, go ahead and outlast that with the capital that they're going to receive from the government. So, it seems to be that way, but I don't know, man. It's more printing money, and it's more inflationary type of things that, obviously we're going to get into that, but it just seems like you're putting Band-Aids on things rather than actually fixing the issue.
It makes Wells Fargo seem pretty smart.
Yeah.
It wasn't just a couple months ago that they decided that they were going to stop correspondent lending.
Yeah, they did. They decided that they were gonna get out of that game, and it looks like they were smart about that. But also, I do want to point out with Wells Fargo, a lot of the issues with Wells Fargo is they were right time, right place, whatever. They were hindered by being bad and not able to actually, join in with other banks and do all the other things and do all these startups. They had their hands tied because, they were, discrimination and all this other stuff and fees and, the typical Wells Fargo stuff. So,
yeah. And, at one point in time, they were the biggest mortgage lender in the country, right? And I think then Rocket, Quicken Loans, Rocket Mortgage, I think they kind of surpassed them at one point in time. Right. I don't know where they are now, but Wells Fargo's probably not the biggest anymore. But I kind of wonder. So these banks that are holding, and not to completely switch gears, but you do a lot of commercial transactions, and commercial, even in a residential environment, is typically in multifamily once you surpass 4 units in one building. So you hit 5 units in a building and up, right? But a lot of times people don't realize that commercial lending can be on a single family house.
Oh yeah.
As a non-owner occupied loan, right? So if a lot of people want to buy real estate in an LLC or some type of corporation, right? So that they have some type of liability protection. And then a lot of banks won't lend on an LLC, but your commercial banks are the ones that will typically do that. Right. So the interesting thing is what I'm really curious about is a lot of these banks' portfolio. I know, banks that are regional that I even deal with. I have loans with these, they portfolio the loan, right? So, in the midst of all of this going on, I don't think we've even seen yet the fallout as far as banks and how they are going to absorb the bad commercial money that are on their books. And a lot of times, so commercial loans, I have some of them at 4.5%, right? Commercial. You can't get a residential loan for that. I was talking with a commercial lender over the weekend, and she said for new business, they're 6.99 with a 20-year, amortization and a 5-year loan, right? Balloon payment at the end of 5 years, 7% essentially. But all the people over the last several years that have these 5-year notes that are getting ready to come due, these commercial, what are these banks going to do when they have to take back this real estate, or they're in a non-conforming situation to where they either need a lot more cash to refinance the property, and then the owners, their rates are going to more than double, go from 4% to 7-8%. Right. How do you think that's going to affect the regional banks? We haven't even touched on that.
I think that it's going to affect them hugely. I just did a video, and I don't know if you've seen the news, is that Blackstone kind of had this same issue. And what basically happened is they owned a portfolio of office buildings. Well, they decided to default on the loan. And the reason why they defaulted on the loan is because the cash flow that was coming in for the building, the value, it wasn't making the value of the actual property. They bought it at, like, let's just say they bought it at 45 million. Well, when they decide to go refinance it, right, and it's 45% vacant, which that's what it is right now, the value dropped by half. So instead of coming up with an additional amount of money to fund that refinance, they're trying to do workouts with the banks. Now, let's just say that happens with a bunch of, single families or whatever, just a bunch of loans that you have to work out. And everybody's expecting the bank to take the hit. Well, that's going to be the same situation that we kind of had in '08 with a bunch of properties that are being wrapped up in these securities, and the value isn't there anymore. And people are handing back these loans. Now, here is the big question mark on this. A lot of these commercial loans, especially the bigger ones, are non-recourse loans. That basically means that you can walk away without them coming after your personal assets. So a lot of these owners will just hand back the keys and say, thank you, I don't need it anymore. I've made my money off of this. I've made my cash flow for the last 10 years off of it, and I'm fine. You can have it back. The property isn't worth what I bought it for 10 years ago. So that's going to be very tough to kind of see when you open up the hood and you see a lot of these regional banks and you see their balance sheet and you go, whoa, what's going on here? You guys took back all of these properties, and now you have to eat the balance. How much is that going to come to, and how is that going to really affect all of these small community banks that don't have what the big four have?
Yeah, they're going to lose. They're going to get swallowed up. They'll be shut down. I mean, just like we saw in '08. It was interesting. You touched on this. There is, and I read an article today where they love to compare our current situation. Now, mind you, it doesn't matter how it happened, SVB, how they failed. Doesn't matter. This is the first that this has happened since '08. Okay. And we're early on, man. We were just cruising along. Everything is kind of going good, man. We're talking about the Fed and the rate hikes, and the Fed met, with Congress, testified and just last week, and talking about, raising interest rates, and then whammo, like out of the blue, all of a sudden we have headline news that SVB has been shut down. And, the interesting thing here is that everybody has been comparing where we are right now to before. Like, well, the banks, they're not going to collapse this time because we don't have liar loans, and we don't have this, and we don't have that. What we have that is so uniquely, I guess, different right now is that, people are in debt, number one, and they don't even realize that what these banks do with our money.
Oh, no.
I mean, you put money in the bank, we've received like nothing. I remember when I was a kid, I would make like 6%, 7% in a savings account, right?
Oof,
and I used to get my statement and look and be like, wow, man, I'm making money every single month. Well, we haven't seen that since I was a kid. And that was a while ago. But my point is that, we give these banks our money. And let's say they did give you 1% or, not even, right? In a CD or something, right? You lock your money up and then they lend this money out, right? They're lending it out 4%, 5%, whatever. Well, what people don't realize is when it doesn't take that much when a bank is lending all of this money to where something like this kind of makes people not trust the bank. And people start withdrawing their money, and now the bank can't pay the bills. Not only that, but the biggest thing we have to think about is now the government in some way is kind of competing with the bank because they came up with these great interest rate 3-month Treasury, these short-term Treasury bill, notes. And I think we just looked it up. What was it? 4.7% or something like that. So let's not count the people that you either have people that have money or you have people that don't have money in the bank. right? And being in the real estate business, I mean, I see a lot where on average, the buyers have less than $5,000 in their bank account, right? They barely have enough to scrape together to put down, right? And then you have the flip side of it, the people that have all the money in the bank and they're keeping the banks afloat,
Right.
right? If they're not the big four,
Mm-hmm.
the credit card banks
Mm-hmm.
that are reaping like big time right now, right?
Mm-hmm.
So how do you think the Treasury, what's your opinion, Orlando? Do you think the 3-month Treasury is going to cause a lot more money to come out of these regional banks? And the big banks are prepared. They're killing it on credit card fees.
Right.
But these regional banks that maybe aren't dealing in as much high profit debt as some of the big four, do you think this 3-month Treasury is going to hurt these regional banks?
You know, yes, yes, in the fact that, right now we're in a very volatile time, right? So just today, everyone's saying that the Fed is going to pivot, he's going to pause, is he going to go up, is he going to go down? And then we had just a couple of days ago, the bank collapsed, SVB collapsed, and then another one. Like, so much stuff is happening so rapidly that the tick of these treasuries and stuff go up and down, and if you don't position yourself the right way, which in a sense you gotta kind of like, you have to almost be, you know what's going to happen in the future to put yourself in a good position to where you don't lose a ton of money. And I think a lot of these banks, they really have no other option. They can't just let their money just sit. That would be crazy because inflation would just eat it up, right? So you have to put it in some type of form of investment that's low risk and things of that nature. So they put their money in the Treasury where they won't have that long-term risk. But if you're going to put your money into something short term, then you have to know that it's going to have there's still a risk to that. And with everything going up and down, I mean, it's just a risk. But my question would be, what other options do they have? What other options, if you don't have the business for loans, which we all know rates are high, demand is down, right? They're not doing credit cards because they're not the big four. And if they don't put their money in treasuries, well, then where are they going to put their money?
Yeah. Well, and the ones that did put a lot of their money in the cheaper treasuries, right?
Right.
They're the ones that are getting eaten alive right now. I mean, obviously.
Exactly.
The Fed. And I'm really kind of talking about consumers. Do you think the consumers are going to be pulling their cash out and from these banks? Because, let's face it, if we have a bank run, right? And I mean, we haven't seen this in a while. So, after the Depression, no one trusted the banks. I mean, people took their money, buried it in the backyard, right? They put it in mason jars. I mean, it sounds like a joke, but I mean, for young people, but this really happened. I mean, I can remember a friend of mine, his dad had passed, and they had this little fish pond in the backyard. And my buddy took the fish pond out. It was one of those raised fish pond, and actually found a tin of money. And it wasn't much. I mean, it was a couple $100, but I mean, but think about back in the day. I mean, people that went through the Great Depression, man, they didn't trust banks. Banks collapsed, right? I mean, people lost their money. So, I mean, at this point, anybody that wants to hold on to their money. So, but at the same point in time, I mean, think about the cash we have in the bank from the sellers that haven't bought yet. They sold high. They're waiting for house prices to crash. They have hundreds of thousands of dollars sitting in the bank over the 250 threshold, most of them, right? What are they going to do with the money? It would not take much for these people to say, you know what, I'm not going to buy a house in the next 3 months. I'm going to take it out. I'm going to put it in this 4.7 3-month treasury. What's that going to do to the bank?
Yeah, I think as for a customer, right? I don't think that most customers will go and take their money out of the bank. And there's a couple of reasons why. Is that most individuals are living paycheck to paycheck. I just saw a report where 68% of Americans are living paycheck to paycheck. So they're for sure going to be covered by the 250, right? And then anybody above that, and even anybody below that, our laws when it comes to buying a house, when it comes to getting anything financed, and we know debt is really heavy right now. Everyone's spending debt on everything on credit. A lot of our laws and binding rules all have to do with keeping your money in the bank. As you know, and I personally know, that if someone comes to me and they have a suitcase of cash, you're automatically ineligible. I can't deal with you, right? You have to put your money in an institution, season the money before I can even touch it, right? So with that being said, our system is too reliant on the banks for it to be, and we're too far in the beginning right now. Now, if there was something like you were talking about the depression, then I could see, everybody kind of moving towards that way. But in the very beginning, and with a situation with it just kind of being like a niche bank, which, that are, most people would consider it a rich bank, right? I don't think we'll see that run.
I think about, and you're right. I mean, most people live paycheck to paycheck, but these aren't the people that can shut the banks down.
True. Well,
just think about, think about for a minute. I mean, I don't know how many I can make a list of friends of mine that have gone completely out of the stock market in the last 12 months.
Okay.
Right. What have they done? They've gone in Treasury bonds, right?
Mm-hmm.
So, I mean, they're not putting their money in the bank, right? So, and I also see where a lot of people, we start thinking about, it's the hysteria. The government comes out or somebody comes out and says, oh, don't worry, guys. Don't worry. What happens? It's an anomaly. It's not, this isn't 3 banks in a weekend. No, don't worry about it. This was a crypto bank. This was a bank that was heavy in tech, 19th largest bank. They were just heavy in tech. They didn't have a risk manager for however long. They just managed the money wrong. They made some bad decisions. They had a bank run. That's what happened. They had a bank run. People pulled their money out of that bank. Businesses, we said it, businesses needed more cash, operational cash. They're losing their butts. I mean, we know tech companies have been slaughtered here in the last year. They've been laying off like crazy, right? So we know that these companies have needed more of their cash. They've been depleting the cash in the bank. Banks need depositors, or they need high debtors, high interest rate debtors that are pumping money into the bank to keep their lights on and all that stuff. I guess my curiosity, look, and I'm not trying to, cause panic, but we have to talk about these things.
So one thing that I want to, when you said that, the 68%, those individuals you don't think are going to be the ones that, kind of cave in, make the bank, close down. And I disagree with that, because when it comes to just as much as a individual, I told you that 68% is living somewhat paycheck to paycheck. A bank is doing the same thing with their depositors, and when their check is going to hit that account, they're looking at, okay, on Friday, we're going to get a bunch of deposits that come in. And it doesn't matter if the person spends all of the money within 2 days. That's still a deposit that they could use to lend more money out. And that's what they're hoping on. So if all of those things were to go away, that 68%, that is a huge, huge dent into all of these banks, because that's deposits that are not coming into the bank. And that's what banks live for. If the banks banks won't exist. If there's no deposits, there's nothing.
Well,
The
there's the
bank is
average
gone.
daily balance, right? I mean, there's the average
Right.
running daily balance at a bank, is skimming off the top, right? And, and maybe it's the other 68% that are pumping them with return check charges and,
Right.
EFTs, right? So,
Mhm.
but at some point, I mean, they still need more than that. I mean, look, I'm not a banker,
Mhm.
but at some point, I mean, I just, I think that they need some heavy hitters in the bank. I mean, that's why they cater to these depositors. When
Mm.
the crap was hitting the fan, and who knows? I mean, look, there are investigators that are involved in it, and they're gonna get to the bottom of it.
Mhm.
The president was calling, from what I heard, was calling depositors up and saying, "Oh, don't worry. They're big companies. Don't worry. Don't take your money out of the bank. Don't
Right.
take billions of dollars were taken out of the bank,
Mhm.
right? I mean, this was a bank run. I don't care what you call it. They couldn't borrow money because they had exhausted that, right? They
Mhm.
had to sell off their treasuries, right? They
Mhm.
they took a hammer to that. And, I mean, people were yanking billions of dollars out of the bank. But anyway, I think I don't know. What do you guys say? What are our questions, Melissa?
Mhm. Let's start with Jolyn here.
Let's go to the audience.
We've got, with the FDIC stating that they won't cover most deposits, what is the thought on how long this will last? Or are we going to go straight to digital?
Okay, did he say that the FDIC was not going
Stating
to cover?
that's what Jolyn said.
Yeah, they're going to cover them. They just
Oh, yeah, they
announced they're
cover.
going to cover everybody. The only ones, my understanding, they flipped on that. So this is a bailout, guys. They flipped
Mhm.
on that. They said, we're going to cover everybody's money. The only ones are not going to cover the investors. And they said, you guys are investors. You knew the risk.
Right.
So they said, look, no to you investors. Your money's not protected. We've got this fund over here that apparently all the banks buy into or whatever. We've got this fund. We're going to make sure everybody gets covered and that your money's available. So as far as I know, that's what's happened. And I
Yeah.
think what Orlando was saying is that's setting a precedence here that what if these regional banks go out? Are they going to cover their money? And it's raising a bigger issue. Should they cover everybody's money all the time above the 250? Is 250 not enough? And yeah.
So we've got a question here from Amit. If I have more than 250,000 in the bank, should I withdraw anything more than 250,000?
Yeah. Go ahead,
Okay.
Orlando.
I
I'll
would
let you take
say,
this one.
I would say that you should have. I would never. I would say that you need to have it in a different account, right? You need to push that money over into a different account. I would not, and I personally, I want to be protected by the FDIC insurance. So I'm not going to have an account over $250,000. And if it is over $250,000, I'm going to take the excess and then put it in another account. So that account is protected by the 250. So that's what I would do.
Now, here's the question. I started to read the FDIC, the bill.
Mm-hmm.
And I mean, it's kind of interesting because I mean, I think you need a specific PhD to decipher the information. But the question is, because it seems quite ambiguous to me, the way that they identify the types of qualifying accounts.
Mm-hmm.
And as to the question, as an account holder, are you covered if you have another account that's over, like you take your 250, you take your excess out of that, you put it in another account with the same same institution.
Right.
Do you put it in with the same institution, or do you put it in a different institution? And I think, to me, just that seems like it makes more sense. It seems a little bit more clear.
It does.
And again, I mean, look, we're not financial advisors, we're not accountants,
100%.
we're not lawyers, we're not, I'm a real estate broker. Orlando, he's a loan officer, he's a real estate professional. Guys, we're not trying to give you legal advice here.
Yeah, what I have seen clients do is instead of doing like an account with my name or with Orlando on it, and then do an account or with Orlando on it, but it's just a second account. It becomes like a different account. So it's like account with my name on it, but then I do a joint account with like me and my son. So it's different types of an account. Or to make it more safe, like you were just explaining, and make it more clear cut, it's just take the money and remove it and put it, at two different banks. And then that seems it's super easy to understand. A different account at a different should be protected the same as the other one at the other bank.
And be prepared to take your DNA, get all kinds of scans at the bank. I mean, have you ever gone in and tried to open up? Oh yeah, I'd like to take this $250,000, please, and put it into a bank account. First of all, you have like this whole list of, battering questions that you have to entail.
Right.
And, of where you got the money, how you got, what you're planning on doing with the money, you want to take your money out of the bank? Oh, well, why do you want the money? Well, it's your money, but why do you want the money? So be prepared for that too.
Yeah, I tell you, I just even on the lending side, I have to grill people, have to follow where the money came from. Is it seasoned? Is it this and this? So yeah, same thing with opening an account, especially that large amount of money you putting in.
Exactly. You just simply say, I don't trust my bank. It's a good idea.
We've got a question here from Lexi. With this bank crisis happening, is this going to hyperinflate the housing market? Mortgage rates plummeted, and that just brings back new buyers back.
I'm so glad that somebody asked this question, because I was just ready for it, right? I mean, we're thinking, so here's the deal. I just had a conversation with somebody over the weekend, and they said, what do you do with money? Like the stock market, there's these, all this rumor going on, depending on what expert you listen to, that the stock market's going to crash 10, 20, 30% in the next 60 days and get your money out of the stock market. And now all of a sudden the banks are, in the news and, insolvent and being in receivership by the feds. And, so what do you do with your money? And this person said, because I'm thinking that I just want to buy real estate. I need to take my money and just buy real estate. Well, I want to tell you guys something. First and foremost, that is not a liquid asset. Mm-hmm. So when you buy real estate, understand that is not something that you can just quickly get your money out of should you need it, right? But I think, Lexi, this is absolutely going to stimulate the market in some way. There is so much going on in the real estate market. And, you have people that are on the sidelines. Again, this is the scenario, right? We have people on the sidelines that want to buy a home to live in. And then we have all this cash in the marketplace that wants to just buy the house, to buy the real estate and sit on it and hold it because they don't need the cash. And it's the safest place in their opinion to put it. I don't disagree with that. I mean, I look at, buyers, especially first-time buyers, and I'm saying, look, I'm hoping that the market is declining, that you can afford to buy something and not pay rent, to where it does not put you in a financial, burden to, fix things and be a homeowner, that it's actually an enjoyable experience, unlike it's been for many people over the last 2 years. But then the important thing is that there are hundreds and hundreds and hundreds and hundreds of millions of dollars, and I'm probably light on that, billions of dollars that are on the sidelines that are waiting to buy up real estate that becomes available because the financial markets otherwise are so unstable and people need a place to live. So I think that depending on what happens here, and I think that's why interest rates responded so quickly. We saw when this announcement first happened, it seemed that interest rates dropped, mortgage interest rates. And, so I think that if we continue to see banks in the news like this, and we start to see where the stock market begins to fail, if it does, it's going to be like any other time. When the stock market goes down, people invest in real estate. And that's what we've seen. That's what I've personally seen several times in my career of 33 years in, real estate. Orlando, you have anything to add to that?
Yeah, I don't know. I don't know do you know how far the numbers dropped by when that news came out? Did it drop? You know how the rate?
Yeah, I think it was, I've seen where almost a point.
Almost a point.
Yeah.
Okay.
In the low sixes, 6.33 when we were over 7.
Right.
Now it depends. I mean, obviously it's credit, right? Debt to income ratio,
right.
That kind of thing, price point, money down.
Right. And here's my thing is that I think that it's a little bit too early to tell because first of all, this just happened this weekend and it's a kind of a knee-jerk reaction to it. We've seen this kind of thing happen when the Fed just announced our CPI numbers come out and rates go down and then they shoot back up. And, the rates themselves have been volatile going back and up for whatever reason. Let it be the market believes that the Fed is going to pivot to the point that people believe that, he's doing too much or whatever it may be, or something comes up out of financial news or whatnot. So it's already been volatile already. So I think it's a situation of the market just kind of doing what we normally have seen it do over the last 6 months, which is go up and down based on the news. And I think with, obviously the news being the big of the banks collapsing and whatnot, I think so long, nothing dramatic happens with other banks or its spreads, I think rates will continue to go back up. I think that the Fed will continue to raise rates and fight inflation and rates will continue to go back up and we'll be back kind of in the same position with individuals who decide that they want to wait and,
I think rates are definitely going back up. I mean,
yeah,
I think more of it is, I think of it as the available inventory. Will this big money being unsure of the other markets that are out there, not being comfortable with the banks, not being comfortable with the state of the stock market. Will a lot of these investors dive right back in despite the house prices being elevated, and just with the available inventory that's out there. One of the things that I'd like to, kind of bring out, we have been seeing where some home builders are raising prices. Have you seen that?
I have. Yeah.
And, it's interesting because you would think that, and, we have in previous shows, we're just saying, what, these builders are going to get hammered. But what a lot of people don't realize is investors are buying these new homes.
Mm-hmm.
They're buying them, right? So what we're seeing that the builders are doing is they're cutting back their production. Mm-hmm. It's almost like they're just standing in unity saying, we're not dropping our prices. We've been unable to, get land developed without tons of, hundreds of millions of dollars in red tape before, sometimes a decade of land development before we could stick a shovel in the ground. now we have all of these lots that are available, and we know that inventory is necessary, and we're going to raise our prices. We're going to cut back on the supply deliberately. We're going to stop building. And we're going to stick to what we have. And it's the price is the price, whether you want it or you don't. And I think with Lexi, what she's saying here is this is a big question mark. Are we going to see where money in the market is like, you know what? If I look at a house that's, let's just say $500,000, and I'm overpaying that 10%, or just say 20%. But I have my money here in the stock market that I can get, basically wiped out overnight. Am I better off buying that 20% today overpriced? Am I hedging? How am I hedging against loss? If I buy this asset, this real tangible, put my hands on piece of property, I know I'm good. Right? I know it's not, unless it burns down, and then I'm going to have insurance versus being wiped out. I mean, look how many people were taken out of, FTX.
Right. I definitely agree on the tangible asset versus the stock, having money in stock. So I totally understand. But that is a question where you kind of are just like, which one am I going to choose here? So Lexi, I totally understand. It's a really valuable question.
Let me ask you a question, Orlando.
Yeah.
What would you do if you had, $1 million sitting in a couple stock accounts or whatever, and you believed that we could experience a major stock market crash? What would you do? Would you buy an overpriced piece of property to protect your cash?
No. No, I wouldn't.
What would you do?
I would find another way. I would put it in, I don't know, like, I guess you kind of you're putting yourself in the same position that the banks are, which is the Treasury stuff. So you could put it there, or, maybe, I don't want to say hold it in there, and it could get eaten alive by inflation. But even inflation is better than it getting ate up by a 20% drop in the stock market. And then you have to pay taxes on that. So it's more than that. And then you losing the money with the asset itself, real estate. So the numbers to me don't make sense to drop it into either of those assets. Especially when you're telling me I'm going to lose 20% on the house, I'm overpaying for it.
For how long?
Well, I don't know. How long? You didn't add that on there. You were just telling me I'm going to lose 20%. So if I'm
saying that the potential is that you could be buying it 20% overpriced.
Yeah. I don't know if I would do that. I just don't know. I feel like I would prefer to wait it out, have my money just sit, wait it out, try to get in where I could fit in, and try to get a home that's not overpriced. I can tell you this, I wouldn't keep it in the stock market if it's going to crash and go to zero, but I definitely wouldn't buy an overpriced home. That's just me, though. That's just me.
I guess the question is, none of us really know. I mean,
right.
So do we really know? That's do we know what's going to happen in the stock market? Absolutely not.
Of course not.
Right. Let's take some more questions.
Talking about, we had a question here.
And Melissa's actually sitting
right next to you
there, but
it doesn't look that way.
Well, wait a minute, he must have reversed it. When I'm looking over here, I'm like looking off the screen, so and she, it's kind of a little bit of an optical illusion here, guys. But Melissa's actually sitting. She's not sitting over here.
No,
she's sitting
we're side by side.
Yeah, we're side by side.
I do want to say something also. One of our viewers, Anna, is from Cape Ann, Massachusetts, and that's where I'm from. That's where I was born and raised. So I saw that come up, and I was like, yeah, Massachusetts. So anyway, but Charlton Zimmerman did have a question. Do you see builders going under bankrupt anytime soon?
Oh, me?
Orlando, you want to take that, man?
Yeah, I mean, yes, especially if they can't sell these homes, especially if they have to take a haircut. You know, a lot of these home builders are on these lines of credit, and I know because I see them all the time, getting these commercial lines of credit, and they have to. Once you start pulling from that and you start taking that clock start ticking on that debt. And so a lot of these guys they have to sell homes. And if they don't sell those homes and at a profit or, at least break even, it's just gonna eat them alive. And it's just the name of the game. As a recession comes, of course there's gonna be some builders that didn't do what they were supposed to or got caught up in the recession or something unexpected happens, and they're gonna claim bankruptcy.
When I was this is kind of a sore subject for me, but one of the very first valuable lessons that I learned in business was working for a national home builder as a contractor. I was, young, had the opportunity. The economy was booming, and this goes back into the early 90s, and late 80s, early 90s. And I remember I was, getting in deeper and deeper and deeper, and they would only give me enough money as a contractor to keep me poor. I mean, it was, I could basically pay payroll, and that was it. And, supplier bills were mounting, and obviously I was concerned. I mean, I was calling everybody that I could, but they were saying, oh, you just have to work in this new subdivision, and we got to get this done, and we need these occupancy permits and whatever, that these are solds that we need to deliver on time. And they just kept pushing and pushing and pushing. And it was somewhere around Christmas, like in December. And I remember that I opened up the mail, and it was a letter from their attorney that said that they were financially insolvent and they were offering 10 cents on the dollar. Basically take it or leave it, take this or don't get any. And they're still around today. Right.
Really?
So I can tell you that, there's a lot of different measures that take place when you're dealing with these big companies. Right. I'll be careful what I say, but I will say that, if you're a contractor and you're working for these companies, I mean, you have to know that you're dealing with a lot of, big money. And so will they go bankrupt? I mean, I kind of think that some businesses use bankruptcy as a tool of operation, whether it's a reorganization, whether it's a way to wipe out debt, whether it's a way, so I guess the question is, will they go away? Will they go bust? Will they not be around anymore? And a lot of these builders that are scattered builders or smaller builders, I think on that scale, the riskiest business is development. The developers either make a lot of money or, they go bankrupt, where they're the ones that take the land, spend the decade of going through all the red tape, get it to the point to where the engineering's there. They put the infrastructure in a lot of times, the roads, the curbs, the gutters, the stormwater management, and then they flip that over to a big builder or developer or a builder that will take it over and build it out. So I think a lot of the risk on the builders are mitigated by, having a developer do a lot of that work up front. They can always liquidate lots, to other scattered builders or smaller builders before they, to kind of save themselves. But that'd be like, to me, that's the last resort, right? I mean, I think they will restructure, reorganize, wipe out the shareholders, as much as, I've had that happen too. But do I think a lot of these big builders are going to go bankrupt? I don't know. I would say if they did, it would be a restructuring tactic. Again, that's just my opinion. But I've had firsthand experience dealing with them. So,
yeah.
Mm-hmm. I'm going to take this minute to acknowledge our super
chat. That looks like I'm looking against her. Man. That's so funny.
super chat.
It's like I gotta
Super-
look the wrong way here. Hey, Melissa.
But Letitia Williams, thank you.
Thank you so much.
Her comment, Lennar Bakersfield is getting desperate. And then we've got Travis here. Travis, thank you so much.
Thank you, Travis.
Real Estate Mindset. Thank you for all the Tuesday night lives.
You ever heard of him before,
Orlando?
I've
never heard.
Real Estate Mindset.
Man, I'll go check. I don't know, man. I've heard him somewhere.
Check him out, man. We love Travis.
His channel.
He's a buddy.
Thanks,
Orlando, me, Travis, Scott. I mean, we talk often.
Yeah, often.
Luke in Canada. Right.
But Cindy Trost has a really good question here. If you put cash into different banks, how long does the money need to season before using it to apply for a mortgage?
That is 100% Orlando.
It's 2 months. 2 months that it has to be seasoned, and not only that, not only does it have to be seasoned, but it also has to be sourced. Meaning, where did the money actually come from?
And there you have it. And then let's talk about next week and the Fed. Question, will the Fed hike rates again next week? Raise rates, I think it's what it's saying here. 50 points or 25 points?
Okay. So I think 25 points. And the reason why I think 25 points is because I think that we have a Fed that's not extreme on one end or the other. I think he's a middle of the fence type of Fed, and he wants to satisfy both sides. The side that says, hey, you broke something, and this is the reason why the banking system is what happened, is because you broke something with your rate increases. And then you have the other side that says, hey, I thought you said that you were here to fight inflation. So why are we, with inflation numbers came out and core inflation didn't go down that much. It's still hot. So he's going to keep both sides of those guys happy, and he's going to do 25 basis points, in my opinion.
Yeah, I think, and guys, if you haven't checked out the video that I published on last Saturday, I strongly encourage you to do that. I covered the Fed Powell addressing Congress, and with the the midterm kind of report, right? Like what the semi-annual report as to what the rate hikes, what kind of effect that they're having on inflation. And I did take some heat because I didn't really mean for it to be a political agenda. There really wasn't. I'm kind of like, I'm kind of middle of the road. I believe in, people that just should be able to make sense in running our country and,
Right.
Make good decisions, whether you're a Democrat or Republican or whatever. So, some people were saying that I was, kind of pushing my agenda, and that's not the case at all. I was covering the story. I couldn't cover all the 2 hours and 40 minutes or whatever it was of the meeting in a 20-minute video. But the long and the short of it was there were some valid points. So we had, Brown, Scott, and Kennedy were three that I captured, their questioning to Powell and his response. And basically, where it was coming from was, look, you're raising interest rates. It's not working. You can say that it's working, but, people are still feeling a lot of pain right now in pricing and, in prices at the grocery store, fixing their car, buying a car, right? Home services, house prices, you name it. This isn't working. What you're trying to do is disinflation, not deflation. And as a result of being successful, the measure for the Fed as their success, the result of their success is that unemployment rates go higher, which means that people lose jobs. Mm-hmm. You can say it any way that you want to, and you can pick one side of the aisle, but history tells us, whether it was a Republican or a Democrat in office, history tells us that when we raise interest rates, it usually causes some type of a recession, and unemployment rates go up as a result. The other thing is that we're doing by raising rates is we're hurting people that have been financing their groceries, financing the fuel in their cars. So we watched the rate of inflation so far exceed a stagnated wage growth. We have not seen wage growth in a decade. You could say, yeah, jobs have gone up all across the board. Wages have not gone as high as necessary for people to afford basic life necessities. And as a result of this, now that they've used their credit cards, we're looking at more credit card debt than we've ever seen. We're looking at people financing cars for 7 years. And in the midst of all of this, we're not looking at reducing costs. We're not looking at record-breaking profit for Wall Street companies. We're not looking at, the stock market doing better than, through all of this, people making just tons of money in stock market. And there's no real pressure on bringing pricing down or encouraging some type of wage growth. And this is the problem. So, when I covered this video strong, I'd love you guys to check it out, watch it. It was not my purpose to have some type of political agenda here. I am a consumer just like you, whether you're a Republican or Democrat. It doesn't matter whether you don't care, whether you don't have a political view. We're in tough shape right now. Probably some of the roughest shape that I think we've been since I've been, out of, on my own as an adult, right? Living on my own, taking care of things. I think that we're going to see more happen. And, I think we need to pay attention to that. So, but as far as whether I think the Fed is going to pivot or raise rates, I think they're going to stay on course to get to their 2% goal. They've been very clear about it. They said not even 3%. We went 2%, which just means sustained cooling. And the Fed basically said in this meeting with Congress, they said, look, we don't care. They didn't say we don't care about energy costs, but what he said is energy costs don't respond to our tool. Basically, the only tool we have is to raise rates. Energy doesn't respond to that. Government spending is not responding to interest rates. So I think there's a lot of, companies that are making record profit and price gouging aren't responding to interest rates. So what they were saying to him is, you're raising the rates with the tool that you have, and it's not working. And they said the blunt tool of raising interest rates. I still think I'm with you, Orlando. I think I saw a poll today. 80% said a quarter of a point. 0% said a half a point. 20% said no raise at all. I think we're going to see a quarter of a point.
And I do want to add into this is that the reason why I think there's so much, discord in between what the Fed is seeing in the numbers, especially when it comes to consumer spending, and what they're seeing in things being cooled down in inflation, is because you have two opposing forces working against each other. You have the banks, which just got hurt, that are giving away credit that is fairly easy to get to allow individuals to buy that inflated product, which is groceries and things of that nature. So if you have more people spending, no matter if it's by their own money they have in their savings account or credit that they're borrowing from JP Morgan Chase or Citi, right? The point is that they're still continuing to spend. And the point of raising interest rates is to stop people from spending, right? You want to bring down the demand. And when you're working against each other and these credit card companies are rubbing their hands together saying, oh, wow, we can make record profits by this increased interest rates. And all we have to do is just make it so much easier here for you to sign on the dotted line and we give you tens of thousands of dollars. I mean, something's got to give here. Something's got to give.
Well, you could talk about cooling down the market, but the people need to buy fuel in their car.
Of course.
They need to fix their car.
Mm-hmm.
They need to fix their things in their home. They need to eat. I mean, I think that, when we're seeing, eggs locally here in a grocery store at $7.99 a dozen of eggs for a dozen eggs. I mean, that's kind of crazy, right? I mean, so, yes, I agree, cooling off spending, but here's what happens when we cool off spending. People lose their jobs. If you have a store or a service and we say, oh, we're gonna eliminate your ability to buy anything because you won't be able to afford it, and if you do, you're going to be crushed and make these banks rich. What does that do to the local business? They lay off people. They let them go. When we do this kind of, rate hike, we're affecting small business. The ones that are, and by the way, I want to say this because I've always been an advocate of small business. Small business is the largest employer in the United States of America. Right? They employ more people, small businesses. And here's what I want to say, because I remember in 2008, I had spoke in front of a group of restaurateurs, and things are really going downhill fast. I mean, local restaurants, just like now, I don't see lines in restaurants like we used to. Right?
Mm-hmm.
I mean, I don't know if you've been out. I mean, we're seeing where, Friday night you can get a reservation where you could never get in there without 2 or 3 weeks in advance, right? Locally owned businesses, right? So the idea was, how do we stay afloat and go to a skeleton crew where service isn't, service doesn't suffer. And, the discussion really got heated and was going around, these corporate entities. These restaurateurs were taking their own paychecks and throwing them in a drawer to pay the cook, to pay the hostess, right? I mean, then you had big corporate stores to make shareholders happy and to keep profits up. They just axed to close the locations. They just let everybody go. There was nobody standing there putting their check in a drawer, right? But when we are harming and cooling demand, we are harming our local environment, our local businesses. We are not harming Wall Street companies. They are getting richer. They are finding ways of automation. They are finding, they put money into a lot, and in most cases, it's not wages and wage growth. So, I don't know what the answer is, Orlando. I'm just saying that I see a lot of similarities echoing 2008. And I think that if we need to learn something from what happened, we need to look in the history books. We need to pay attention. We need to, be thinking about, how we're going to get through this.
Yeah, I 100% agree. If you look at the history books and you look at what happened before, you'll see a lot of similarities. And I know a lot of people are like, oh no, wait, it's not the same. It's, it's not even close, blah, blah, blah. But you can really see the right, something has to give here. And, that Congress meeting that you're talking about, one of I forget her name, I think Senator Warren, she was really going, in on the Fed, asking them like, sir, you telling me, you want 3 million people to lose their jobs? And he didn't want to say it, but the answer is yes. That's based on his terminology and the way that he's playing word salad at Congress. I get it. But the truth is yes, he's saying, the way that we have to raise rates, that has to happen. And that's what they want to see those numbers reflected in a report where 2 to 3 million people lose their jobs.
So what do you, if you had to say a prediction to get down to 2%,
How many people have to lose their jobs?
What will the unemployment rate need to go to?
Ooh. Where are we at now? 3.8, something like that.
As far as what?
As far as unemployment, where are we?
Yes.
Where are
Yep,
we
yep,
right now?
yep. Like
3.8.
3.8. Yep.
Okay, 3.8. I would say we have to get to 5. Maybe a
So-
little bit. Maybe a little bit north. Maybe a
Yeah.
little bit north, like low 5s. I would say.
At 2%, one of the senators had made mention that we would need to be over 10%
For unemployment.
to hit the 2% goal.
Ooh.
But history, that's based on history.
Here's the thing that I've been on my channel. I've been stating is that the Fed is so big on this 2% number that they're willing to either fall on that sword no matter what. And they're continuing to say 2%, 2%. And the Fed has had many times to revise that number and say, you know what, we're willing to do 4. Okay, guys, look, we're willing to do 4. But he comes back every single time and says 2%. And I tell people to get down from that 6 to 5. Okay, we can do that. 6 to 5. What about 5 to 2? What about when we get to 5? How hard is that going to be? That is going to be so painful. That is going to be a lot of pain.
That is a lot of cooling off, and that is going to cost a lot of jobs. I'm telling you, I've already seen it. I mean, I'm talking with people, and they're just, people are looking to shrink their business models down. And, and I've said it before on the show. I went to a Internet of Things conference years ago. And in fact, Orlando, you probably know BOMA, Building Owner and Managers Association, being in commercial real estate. I went to the BOMA conference. I think it was in 2017 down in Nashville. And, they were talking about, how the employers are reducing the size of their staff, their companies. I think we're going to see this. There was a prediction back in, that 2017, 2018, where they were saying that like 50% of our workforce would be independent contractors in 5 years. Now, I know that the pandemic probably did slow that down a bit, but I think we would be absolutely insane to not think that if we're going to be able to survive, and make decent incomes, we're going to end up seeing a lot more people become independent contractors, starting their own businesses, right? Becoming consultants of their craft, and I don't think that's a bad idea for many to get their side hustle going, because I think that businesses are going to want to pay less. And we know that the cost of having employees is going up, right? So businesses are going to look for other avenues to where they can hire somebody as an independent contractor for a specialized, service. And then there are going to be people that are going to be happy to do so. They're going to be happy to take that check. Yeah, let's take some more questions.
Okay.
That's like I looked at the wall. I love you, Orlando, man. This is fun.
Yeah, it is. I love this.
So we've got market mania. What do you think of M2 money supply in the U.S. collapsing? Are you familiar with M2 money supply?
Yeah, I'm not familiar with that.
Okay.
Me either.
Yeah, I wish I could answer that for you.
That's
I
okay.
wish I could too.
We're going to move on to another super chat, super cash.
Super cash.
Greetings
super
from the
cash.
past and still catching up. Questions: how would the push to Fed coin influence this if it becomes a contagion?
In my opinion, I think that the Fed they've always been trying to push this Fed coin, this Fed coin thing, especially as I feel like they're really trying to put in a lot of regulation and stuff that's on crypto in general, right? And why adopt all this stuff when you can do it yourself? But I mean, here's my thing with this Fed coin thing. To me, is it Fed coin what we kind of already do? I mean, pretty much everybody works off of digital numbers in their bank accounts anyway. So what is the really thing? But I don't think that this whole collapse will speed that up or anything like that. I think it'll be on the same path that it was previously. I don't think it actually like we have to really get into this digital age because I think we're kind of already in it, in my opinion.
I mean, Bitcoin's up, right? I mean,
Right.
I think over January they're up significantly. I think about this a lot.
Mm-hmm.
I think in order, I know this sounds extreme, but I think in order for that to be a serious consideration,
Mm-hmm.
we would have a complete financial collapse of the dollar. Because despite anything, it's still, I mean, if you think about how many other countries have our cash stockpiled,
Right.
right? So we would have to have some kind of a massive collapse, which I'm not saying can't happen. But I think if we're going to believe in digital currency over the dollar, I think a lot of other things are going to take place before that would happen. I'm
Yep,
not
I agree.
so caught up on that.
Yeah, either am I.
We have got, the Duke. He's just making a statement here. I just want a home, no question. LOL. Just want a reasonably priced home.
Well,
I'll
get it.
get there. You're all invited to my home warming. So we'd be glad to attend.
I hope to get an invitation.
Yeah.
And we hope that
Yes.
you get what you're looking for. I know so many of you are looking to buy a home. And, I know it has been extremely tough for you. And, for many, it's becoming even harder. And, I think that I'm very hopeful that if anything comes out of an economic downturn or some kind of a hardship, as far as consumers feeling the pain, I hope that more inventory opens up. I know we have a lot of
Right.
vacant properties that are second homes for people. I know that we have a lot of people that have investment properties that they're doing for short-term rentals and long-term rentals. Unfortunately, I think that some of this pain is going to teach them a valuable lesson. I don't like that to say that, but I think that we are going to see more inventory come up. The question will be, how strong will our financial system in the stock market and the banking be that this big money doesn't come right back in and gobble up 40 or 50% of the available home inventory that would essentially prevent the prices from softening enough that you can, compete, especially if you're dependent on, things like seller cash to buy. You don't have enough money saved up. But I do want to say that we're not seeing, this time of year, we're mid-March, guys. I would love to be reporting to you, telling you that we have this massive inventory hitting the market. It is still so short, and this is the time to see it. Right now, mid-March, we would be seeing a lot of this coming soon inventory hitting the market, and it's just not there. What we are seeing is the inventory that is still on the market, where people have not pulled it off the market because they're not willing to drop the prices. We are seeing that the limited inventory that has been on the market now for more than 35, 40 days, we are starting to see significantly more price reductions. But a lot of this inventory has just been because you don't want it. That the buyers that are out there, they just don't want it for whatever reason. So I wish I was reporting, Orlando. I don't know how it is in your city.
Yeah, it's the same thing. Same exact thing. Yeah.
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 So we'll take a couple more and we'll
Sounds good.
before we close up for the night.
Sure. Yeah. We have Yumoto here. Do you believe that higher inflation is coming with so many bailouts and the pressure for the Fed pivot mounting?
Yeah, you or me?
Go ahead, Orlando.
Okay. I do believe that higher inflation is coming. I mean, especially if if the Fed, in my opinion, I think the Fed should be a little bit more aggressive. I think he's doing the, middle of the road type thing. And I think that if you would just go ahead and raise up interest rates to actually, push down that demand, then, you could start defeating inflation rather than every month we come and we see, oh, well, it only went down just a little bit, or it's the same, or whatever. But also, I just want to really knock this home, is that I'm not concerned so much with inflation going up. I'm concerned about this 5 to 2% that he's trying to wind down, because I believe that's when the Fed is really going to start kicking things in, and that's when I'm expecting things to so-called break down in that 2 to 5% range. But there's a ton of things that are going up. If you look at that CPI report, you see things like services, like we were talking about, wage growth hasn't even grown at all. There's just so many like red flags that you see on that report that it's quite concerning. It's quite concerning. But for me, 5 to 2 is really what I'm looking at.
Yeah, and I think that inflation, I mean, I'm sticking with, we don't need disinflation, we need deflation. I mean, we need price reduction. And we need it across, all of the sectors. I think that it is very difficult, to expect that we'll see significant wage growth unless we see more people becoming self-employed. And, and I don't know how many people are prepared to do that, since their cash is being depleted every single month. It's bled out. And you guys, I mean, you're my audience. I mean, you would know if you're seeing where you have less cash in the bank today than you did 6 months ago, or that you're now starting to realize. I have a friend of mine in Florida, and I mean, this is a retired person, sold his business, he's doing pretty well. He told me today, Todd, I didn't really think I would feel inflation, but he is. And so I think that, will we see increased inflation? I think we are going to see interest rates continue to rise. I think that we will see, I mean, obviously, these credit card companies are maxed out at what they can charge you, capped out as to what they can, charge you. But I think that as far as lending, to buy a house or for commercial lending, I think we're going to see interest rates get much higher than where we are right now, because I think the risk is going to grow for somebody to lend money as, the economy tries to hold up during the next couple of years. We have a political football going on right now. Okay. We have a big election year coming up, obviously, in 24. We're going to have a lot of slinging on both sides over the next 12 months. I personally don't think that we're going to see anything fantastic happen for the next 18 to 24 months. I think that everybody has an agenda. We're pushing agendas, and, and we are, we're seeing people struggle. So, as the pressure comes up, will we see inflation reduce? Okay, that's great. We get there at 2% by crashing this market and, prolonging this pain over the next 18 to 24 months. What's the end result of that? I don't think prices are going to go down, and that's really what we need. And then we're going to be dependent upon our jobs to give us more money. And, as they're struggling to keep the bills on, another thing, I've had a couple of people that have reached out to me and just conversation. They said, they've fallen behind. They're a business and their electric bills like $10,000 a month, $20,000 a month. I mean, when you have a commercial business, your electric bill can be pretty expensive, keeping the lights on. So, a lot of times they're struggling, and I've had a couple of people that have said, they've been delinquent on their electric bill a couple of times. And then they got a letter from their electric company saying that they were going to assess a deposit in the next billing cycle for like the amount of their average bill, $20,000. Now, if a company's having a hard time staying current on a $20,000 electric bill, making it $40,000 in the next month is not really going to help them, right? So, what are we going to do with these people if their electric goes off? So, I mean, I just think that, this is the kind of stuff that we're going to see in this economic downturn that we haven't even talked about yet. And we saw it in 2008. Here we are, 2023, facing some of the same issues that we've faced in the past.
And I want to add to that is that, I came from a conference. It was a big banking conference, had all the big guys there, all the, big hedge funds and everything. And I can tell you, everybody wants the Fed to reverse. They want him to cut rates. And they don't care how he gets to it. They just want him to cut rates. Stop crushing the mortgage demands. Stop crushing all the other stuff that the products that banks offer at a high interest rate. It's hard to sell. It's hard to sell banking products that are attached to interest rates when interest rates are high. And most banks want to go back, even though we won't go back there, is they want to go back to the pre-heyday 2 years ago, everything really low, everybody can get cheap money, and it's not going to get there.
They made a fortune.
Of course.
They made a fortune. I mean, they're getting money close to 0%.
Yeah.
I mean, they're making a fortune, but and here's the issue, and I don't want anybody to misunderstand me. I'm not saying that I want interest rates to go to 4%. I'm not saying that I want them to go 5%. Okay. Over the last 40, 50 years, the average has been like 7.7%, I think, on a 30-year fixed rate mortgage, taking the 80s into account where it reached 18%. That's not the issue here, guys. The issue is that we allowed, by lowering the Fed rate to almost zero, the wholesale rate essentially to almost 0%, it allowed the prices to look, and then we printed all this money. One would have to say, I don't know if they were smart enough to figure it out at the time, but one would have to say, when you print that much money and you lower rates and people spend money, it's going into the pockets or the coffers of something, right?
Correct.
It got absorbed. It's getting absorbed. It got absorbed. It was spent. But anyway, we'll take one more and then we'll call it a night.
Since we're just going to continue on this subject, do you think the Fed needs more granular tools to specifically control the housing market? Any thoughts on what that would look like?
It's kind of hard when the horse is out of the barn.
Yeah. I don't know what that would be. I really don't. Do they need more? Of course, I would really hope that they would have more tools. But then again, I think a lot of times people don't really want the government really so entrenched in every single thing they do, on housing markets, on this and that and this and that. So I think there's just pros and cons to both of them. And I don't know what tools that they could have, because I'm not the Fed, so I don't really know. But it would be nice if they could have something that had all upside and no downside, but that doesn't exist.
Yeah. Well, guys, there you have it. We appreciate you, Orlando, for joining us tonight, man. We just, can't tell you how much we love having you on the show. And if you guys have not checked out Orlando, please do subscribe to his channel. He has an amazing channel. He is so dedicated into bringing, all the issues that are happening in the news, the housing market, lending, to a very light conversation. He laughs a lot. I love his laugh. He's full of energy. He's just a great guy. And but check him out. Subscribe to his channel, guys. We appreciate you, Orlando. Thank you so much.
Oh, thank you for bringing me onto your platform, man. I love it. Every time I come, I have a great conversation. I forgot we were on the live for a second there, and I was just talking.
That's how it is.
We'll get ourselves in trouble that way.
Yeah, right.
It's like I forget the world is listening.
Yeah.
I
Yeah.
really appreciate it. Melissa, thank you so much. I'll look
Thank
this way,
you.
so it appears that I'm looking at you.
Thank you. And thank you, Orlando. Thank you for taking the time to come on, answering the questions. We had so many tonight, so many that we couldn't even get to, but very thankful for you being here with us tonight.
Yeah,
And I
no
would
problem.
like,
Thank you.
oh, sorry, I didn't mean to interrupt you there, buddy.
No,
And I
no,
would
you're
like
good.
to plug our new YouTube channel we are working on. It's called Real Estate Agent. It is below. If you want to scroll all the way down to the bottom of our channel, guys, we would love if you're a real estate agent or you're a loan officer, a title company, anybody that's serving the real estate business, whether it's commercial or residential. We are going to have some great interviews with top performers, top producers, especially ones now as we're going into this turbulent time that we want to talk about, how did they survive '08? So if you want to learn more about that, you can subscribe to that channel. And guys, we love you. We appreciate you spending your Tuesday evenings with us. We love your comments, and thank you so much. You guys have a great night. We'll see you next time.
See you next time.
See?